Ladies and gentlemen, Greg Michalowski from Forex Live, where I'm going to take a look at the technicals going into the new trading week with a little comment about what we just experienced last week. So let's get started. We'll start with what happened last week. And if we take a look at the weekly charts of these currency pairs, and I want to focus on this bottom chart down here. This is the average trading range for one period. So when you have a weekly chart, you take the average trading range. It gives you the range for the week, and you compare that to other ranges going back in time to determine whether a market is either trending or non-trending. A high trading week like the one that we had right here, this would be more of a trending type week because it's the highest. The market's moving. It has a big trading range, whereas this week right that we had last week is non-trending, and you can tell because it's the lowest trading range. So we only had 91 pips for the euro versus US dollar. That was the lowest trading range going back to November, non-trending. Let's take a look at the dollar versus yen. If we take a look at the trading range for last week, it was 158 pips, non-trending. You have to go back to early 2022 to have a trading range that was less than that. The sterling versus US dollar, only 121 pips, most narrow trading range going back to 2021, non-trending. Let's take a look at the dollar versus Swiss, and it had a trading range of only 95 pips. That was one of the lowest trading ranges going back to early 2022 as well. So you get the idea that the markets were non-trending in the major currency pairs. That is indicative of a market that doesn't know which way it wants to go. Why does it know which way it wants to go? Because we're sitting on the fence. So in most countries, as regard to inflation, regard to growth, regard to policy, and that has the markets sort of locked in, and traders trading the ups and downs rather than the trends at the moment. But what we do know that non-trends transition to trends. There is something that ignites the fire either to the upside or the downside in the US dollar or another different currency pair. So it's in fact the dollar versus Canada moved to the upside last week. Why? Because oil prices moved to the downside. So it was one of the currency pairs that did not non-trend last week. So these are the types of stories that you look for as the week goes on, the fundamental stories, and the technicals will help you tell that story as well. And that's what I want to look at next, by looking at the technicals more of the shorter end to see what are the key levels that are in play as we head into the new trading week, as we head into this period where perhaps we move from non-trending to trending. Let's start by taking a look at the euro versus US dollar. And what we do know is that the trading range was very narrow last week. The high price came in on Monday. The low price came in on Monday. And in between, we had ups and downs in between that high and in between that low. What we do notice on this chart is that there is a swing area, this yellow area right here, where we had a different ceiling levels through here. Then it became a floor, and then it became a ceiling once again. The last time the market tested that ceiling was on Monday before the market moved to the downside. So we are moving higher, and we are toward that ceiling. And it comes in around the 110 area, really 109.99 up to 110.06. If the price is able to get above that level, that would open the door for further upside. And we hope for some sort of trendish type move in that direction that might take the price to 1.1075 and move above that level in the trading week. Get a bigger trading range. Remember, if we only had 91 pip trading range last week, we are currently at 109.88. So to get to 110.75, that's what, 75 plus 12, that's only 87 pips. So there's a room to roam if the market is able to break above the 110 level and stay above that level. And then we're going to look toward the high price here to look for that next opportunity to take it even further. Take the range, 150 pips, 160 pips. That's sort of the goal. Now, it doesn't go in a straight line. We have moves to the upside, moves to the downside, and moves to the upside, and moves to the downside, and so on and so forth. And we'll analyze that as the week goes on. But that's the goal that we want to see happen, is get above the 110 level and stay above that level, and then we'll look toward the 110.75 level for the target, as long as the price can remain above this level. Now, on the downside, you can see the 100 and 200 hour moving averages are in play, at least in the last half day of the New York session, where the price held the 200-hour moving average. The buyers were making a play to the upside, the dollar moving lower, the euro moving higher, and we'll see if that can continue in the new trading week. If the price can remain above that 200-hour moving average in the short term, that would keep the bias in that direction, direction. But if the price were to move below that level and then move below the 100-hour moving average, we'd start to look toward rotation back toward this yellow area. This yellow area defined again by different swing levels. There's swing highs through here, became a floor level through here, then became a swing high area through here once again. And we did the same thing right here, found support, found some support. It got a little messy, admittedly, in trading at the lows of last week, but we reestablished support within that yellow area on Thursday and Friday on three different occasions. Market buyers came in, and pushed the price to that upside. So we're going to need to get below the 109.25 level. If we're able to get below that level, we look toward the 50% retracement of this move to the upside here, and then we look down lower if we break below that 50% retracement as well. The 50%, by the way, was also a sort of a support area through here. You can see the different lows through here, bounce off, break below, bounce above, come down and take off to the top side. So 50% at 1.08941 would be a key level to get to and through to increase the bearish buys for the euro versus US dollar. All right, let's take a look at the dollar versus yen next. And if we look at that currency pair on the hourly chart, again, a little messy up and down price action. 1, 2, 3, 4, 5 right here. So this is a high, this is a low. In trading last week, the Friday, we moved to a new session low, but we could not sustain the momentum. The market moved back went above the 100-hour moving average. So traded below the 200-hour moving average, traded above the 100-hour moving average. That's indicative of a market that really doesn't know which way it wants to go, isn't it? So we're closing the week in between those two levels, and we're in the short term, we're going to be looking for a break above the 100-hour moving average to give us some sort of bullish bias. And if the market should move to the downside, we look a break below the 200-hour moving average in the low for the week to give us some confirmation of further downside momentum. On the downside, if we do break below the low price from last week, below the 200-hour moving average, and by the way, this swing area right through here, we're going to see the trend line being tested. If we get below that level, we got 38.2. Then we got this 100-day moving average. The 100-day moving average gets a little bit more attention. Why? Because it's the 100-day moving average. Admittedly, back here, the market moved above and below it through these period. But then on the last break right here on Friday of last week, the market ran through that level, or first it came up to that level, found sellers, and then ran through the level and hasn't been back to the level since. It is moving to the downside. So getting below that 133.01 level, it also comes in a nice little round number near the 133 level, would give traders more confidence that the upside is out of steam and continue to move to the downside. But the first test would be get below the 200-hour moving average, get below the low from last week, and look toward the 100-day moving average. On the top side, it's simple, get above the 100-hour moving average, and then look to take out the highs at 135, 131, and that opens up the door for further upside. That high price that we saw in trading last week right here, and it's not necessarily near. We had prior highs through the month of March that moved up all the way to the 200-day moving average, but it would open the door toward a potential move toward that 200-day moving average of 137.89. So that's how I see the dollar versus yen. Let's take a look at the sterling versus US dollar next. And like we did in the other currency pairs, the trading range last week was fairly limited, very limited up and down price action. It was really volatile on Wednesday where the price moved higher and lower, higher in big ranges right here. You can sense that the market got a little bit tired on Thursday because the range was less than we saw on Wednesday, but still up and down volatility. And the same goes true for Friday where the market moved sharply to the downside, found support ahead of this swing area right through here before rotating back to the upside. We are closing back above the 100 and 200-hour moving averages. The same pattern exists for this currency pair as we did in the other currency pairs, in that the 100 and 200-hour moving average are in play and the price is trading near those levels to end the trading week and will become new barometers into the new trading week. As long as the price can remain above this level, then the price action would look toward the high from last week and then start to look toward the high prices that we saw in prior weeks, including back here near the 125.24 and the high price that we saw in trading the week prior at 125.46. That would be the goal on further upside momentum for this pair. Get above stay above the 200, move above the high from last week, then start to look toward the high prices that we saw in prior weeks, and try to make its way above the 125.46 level. That would be the upside momentum move. On the downside, break back below the 100-hour moving average, and guess what? The bias turns back to the downside once again. You just have to listen to these levels, folks, even if it is frustrating. But then we start to look toward this swing area through here, where we had, we can roughly call a number of different times where the market came into this area, either found support or resistance against the levels at all these levels through here. Admittedly, it wasn't necessarily the cleanest of moves, because the market is non-trending through here, so it gets a little bit dicey at times. But I would still want to see the price move below the 123.60 or 86 level, and then open up the door for this swing area down through here, where it's maybe a little bit better as a bias defining level from a floor or a ceiling perspective. More of a floor area through here over all this time period right here, going back 3 or so weeks. This is the area where the market found support. So getting below the 133.43 level, or 123.43 up to 123.60 level would open the door for further downside momentum in the sterling versus US dollar. That's how I see this currency. Looking at the dollar Swiss next, the same ups and down price action, but the market is closing near its lows for the week, and in fact, into the close on Friday, the market moved to a new session low for the week, but it did bounce back before rotating back to the downside and closing near the low from Monday's trade in Friday's trading. So what we did see on the last couple days of trading was that the market did respect the moving averages. The high price that we saw on high prices that we saw on Friday stayed below the near converged 100 and 200-hour moving averages, keeping the bears more in control. When we take a look at Thursday's trade, the high price right here, and actually we can go back to Wednesday, the high price right here stayed below the falling 200-hour moving average. So the bears were keeping in control here, and they increased the bias to the downside on the corrections up to the 100 and 200-hour moving average. Found sellers, and closing again near the lows for the trading week. So sellers are more in control. It would take a move above the 100 and 200-hour moving averages to turn the bias back to the upside here for this currency pair. If it does get above that level, then we look toward this trend line connecting highs to a high right here, and above the 50% retracement of this last move to the downside as well. That would be the next targets to get to and through, followed by the high from last week. Then we look toward this swing area through here, where we had different swing lows forming a floor all through here. Nice little floor right there. Extended all through here, and then became a ceiling right through here, where the market then moved to the downside. So this area up here, about now near the 0.9027, 0.90535 level, would open the door for further upside break above that level, and we look toward this swing area through here, where the market again found a ceiling through here, and then broke through that ceiling to make it a floor and break below that level and move all the way to the downside. So this area up here would be the next key target on further upside momentum. So that's the upside play. But right now, the bias remains more to the downside, because we did stay below the 200, did stay below the 100 and 200-hour moving averages. On the downside, we would have the obviously the low price from Friday's trade, and then we look toward the low price from last week's or the week before's trading, which took the price down to the 0.88591 level. That would be the next key target on the downside off the hourly. Now, breaking below this low at 0.8859 level, you have to go all the way back to the weekly chart, because that low represents the lowest price going all the way back to back here in 2021. So it would be a multi-year low price for the dollar versus Swiss franc. Open up the door for this little swing area. Again, this is the weekly chart between 0.8822 and 0.88, looks like 379. Get below that level, and we start to look toward the low price from 2021, which came in at 87.56. So, we are pushing sharply to the downside here in the dollar versus Swiss franc, and testing multi-year lows. So this is sort of a key test in the new trading week. If the price can start to move, stay below the 100 and 200-hour moving average, move below the low price right here open up the door for these multi-year lows. So we got to be aware of that. We also have to be aware that perhaps, the market feels like it's oversold and it can lean against those low levels and see the snapback rally. So watch the 100 and 200 hour moving averages. It's going to be a key barometer in the new trading week. The next currency I'll take a look at is the dollar versus Canada. And what we saw in trading last week was more of a trendish type move to the upside. This currency pair was one of those currency pairs that did not have a non-trending week. What was the catalyst for that? Well, prices moved sharply lower in oil as it filled the gap going back to the OPEC Plus meeting where they cut production. Lower oil prices tend to lead to a lower Canadian dollar, and that may have been the catalyst for moves to the upside. There was also some technical moves as well, which we'll outline right now as we head into the new trading week. And what we saw in trading last week was that the price tried to go below the 100-hour moving average here on Tuesday after breaking back above it and above the 200-day moving average at this level right here. So the buyers made a play back above the 200-day moving average. That's a green line in this chart. Back above the 100-hour moving average here. Couldn't do it and then failed. And then we started to see some sellers through here, but we fell short of the low price that we saw here. And the market started to rebound back to the upside, and all bets were off. We started to see more buyers come into the market. And then on Wednesday's trade, the market moved above the 200-hour moving average. And after one last dip below that level, we rotated back to the upside. It was higher on Wednesday, a little bit higher on Thursday, and up and down trading. Bigger move to the upside on Friday's trade. Now, the high price that we saw on Friday did run into some key resistance targets. That resistance target comes against this old floor right through here, where the market tried to bottom and moved up, and then that floor became a ceiling through here. So floor becomes a ceiling, and the market moves to the downside. We returned back to that old ceiling right here and rotated back to the downside. And what did we do in trading on Friday? We moved back up to that ceiling and found some sellers again, just because. And as we head into the new trading week, we have this ceiling area between the 135.53 and 135.63 level. Also near that level is the 50% retracement of the move down from this high right through here to this low right here. So a lot going on right here in between or near the 50% retracement and near this swing area up to 1.35638. That is going to be our key barometer for the new trading week. If the price can get above that area, we can see continued upside momentum here in the dollar versus Canada. If we find sellers against that level, a key would be getting back below the 100-day moving average. That's the step blue line right here. Admittedly, the price moved above it here and then failed and rotated back to the downside. We moved above it here and failed. We moved above it here and failed. So these the 100-day moving average has a history of being a price that moves above it and fails. But so we'll be watching that very closely to see if the price can stay above that 100-day moving average. If it can't, we look back toward this swing area right through here near the 134.80 level of 134.88. And if we move back below that level, then we look back toward the rising 100-hour moving average, it's a blue line in this chart, and see if the price can get back below that level. But right now, obviously the buyers are more in control as the trend is more to the upside here in the dollar versus Canada. But we have some key resistance to get to and through to increase the bullish bias for this currency pair in the new trading week. Looking at the Aussie versus US dollar next, again, volatile up and down price action on the hourly chart here. 1, 2, 3, 4, 5. The high price was on Thursday's trade. The low price was on Friday's trade. And in between on Monday, we did have a lower price that was broken on Friday, but could not sustain the momentum to the downside, and the market rotated back to the upside. From a technical perspective, what can we say? Well, the move to the upside last week tried to get above the 200-day moving average here, and each of those the times the market moved above those levels, we started to see sellers come in and rotate to the downside. So the 200-day moving average unsuccessfully was broken and then successfully held resistance before moving to the downside. Also, the 100 and 200-hour moving averages are in play, and then trading on Friday, the market moved below those levels, and you can see stayed below the higher 100-hour moving average, then tested the 200, and then stayed below the 200-hour moving average. So as we head into the new trading week, those moving averages will become key barometers in the new for resistance. If the price can stay below the 100, 200-hour moving average, the bias remains to the downside. Now, on the downside, we have this other swing area where we had support come in on Friday's trade and also on Monday's trade. this swing area goes all the way back to this area right through here, where we did see the price waffle above and below the swing area on these 2 trading days, but then found resistance sellers against level here, here, and here. Each of those times, market moved lower, 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 and you can see that trying to keep a ceiling on that pair. Then once we moved above that level, we had that sharp move to the downside and found support against it here, 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 and here. So what was once a ceiling through here now becomes a floor in the new trading week, and as long as the price can remain above that level, that would give the battle between the moving averages and this swing area, keep it in play. But if we move below that level, it opens the door for further downside momentum with this swing area down here, and then we'll look toward the low price that we saw in the month of April down here at 0.6618 as the next key targets on the downside for the Aussie versus US dollar. So sellers are more in control, but we have work to do to get below the 0.6676, 0.6680 swing area. If we're able to get below that level, it's more bearish. On the top side, move above the 100, 200 hour moving averages. And, we do have this swing area here, but it's kind of messy, to be honest with you. I would look more toward the 200-day moving average as the next key target on the top side. Once again, the price tried to move above that level here and here and here in trading last week, but could not sustain the momentum. The buyers had their shot here. They failed, and the buyers turned the sellers right through there. So this 200-day moving average is going to be a key target that's currently at 0.67425. Get above that level is more bullish for the Aussie versus US dollar. Finally, let's take a look at the New Zealand versus US dollar. And from a technical perspective last week, what was key to me is the inability to get above the 100 and 200 hour moving averages here. This is on Wednesday's trade. The market came sharply to those moving averages, found willing sellers against that level, rotated to the downside. In trading on Thursday, the price tried to move above the 100 hour moving average, but once again failed and found sellers moving down to the low price on Friday. Now that low price on Friday also moved below the 200-day moving average. We did move below it on Thursday as well and failed, but this time the price moving below the 200-day moving average stayed below that level, and the corrective move to the upside here found early sellers against the 200-day moving average. So sellers are taking more control into the weekend, into the new trading week, below the 200-day moving average, below the 100-hour moving average, below the 200-hour moving average. All those levels would need to be broken on the top side if the buyers are to take more control in the current trading week. So sellers are in control below the 200-day moving average, below the 100, below the 200-hour moving average. And you could probably add this swing area through here as well. That those would be the levels that would need to get to and through on the top side if the buyers are to take more control. Absent that, and the sellers are in more control. Now, you can see on the hourly chart, there's nothing here to grasp onto, so we have to take a look at the daily chart to see where we stand as far as the New Zealand versus US dollar. And you have to go all the way back to this day right here, which is March 10th, where the price had a lower level than what we saw on Friday's trade. And as you can see, this 200-day moving average was a key support level, not only in more recent time, but also going back to this point right here in March, where the market came down to that level and bounced off that level. So the importance of the 200-day moving average going into the new trading week. Now, on the downside, if we see further momentum, we could look toward the 0.6055 to 0.608884 level as the next key target area. That level is defined by different swing lows through here, where the market bounced and moved to the upside. Then we came back down toward that area. Got a little messy through here as the market broke and failed and broke and rotated to the downside. In trading here in the month of November, the price moved above that level and then found support buyers against this level, reestablishing this level as a key technical level because the markets moved to the upside, then came down and retested that swing area through here and here before rotating back to the upside. So you can see the importance of this swing area on the downside for the New Zealand versus US dollar. If we continue to push in that direction, stay below 200-day moving average, this would be the next key target in the new trading week. If we move below that level, then we look toward the 50% midpoint of the range since the low price going back to 2022 to the high price that we saw in early 2023 or February 2023. That would be another key level on the downside for the New Zealand versus US dollar. So there you have a look at all the major currency pairs, a pretty detailed look of each of those currency pairs. I hope it sets you up for the new trading week from a technical perspective. You understand what levels are in play as we move from non-trending to potentially trending in the new trading week. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.